3 years of investing can look like progress right up until the market gives you a reason to question all of it. You open your brokerage account before work. The balance is down again. Not a few dollars. Not a normal bad day. Enough that you start doing the math in your head. How many paychecks did it take to build this, and how long would it take to build it back? You close the app. 5 minutes later, you open it again. Then comes the thought that feels almost responsible. Maybe I should just get out. That's the dangerous part. Because building wealth isn't simply about choosing good investments. It's about what you do when the investment you trusted starts testing you. There are 8 stages almost every serious investor has to face. The first is learning how to start. Then comes the harder part, continuing when progress feels painfully slow. Later, your biggest problems aren't necessarily finding returns. They're controlling your emotions, your spending, your taxes, and the amount of risk you've allowed into your life. And eventually, there's a point where your money can start giving you something a paycheck never can: choices. By the end of this video, you'll know which stage you're in, what usually knocks people out at each level, and why one decision during a bad market can matter more than hundreds of good decisions made while everything was going up. Before we get into it, hit like, subscribe if you're serious about building long-term wealth, and tell me in the comments where you're watching from. US, Canada, UK, or somewhere else. Let's see how many people are building this with us. Now, start with the number that looks almost too small to matter. Stage 1, your first $100. Maybe that $100 came directly from your paycheck. Maybe you saved it by cutting back somewhere. Maybe you simply decided that instead of spending the money, you were going to put it to work. You transfer it into your brokerage account and stare at the screen for a moment before buying. The funny thing is, nothing about your life looks different afterward. You still have the same job. The same bills. The same rent or mortgage. But financially, you've crossed a line. For the first time, part of your income owns an asset instead of simply disappearing into your monthly expenses. That's the first shift in thinking. You're no longer only earning money. You're beginning to build something that can potentially earn alongside you. And then the checking starts. You look at the account that afternoon. It's up $1.20. You check again before dinner. Now it's down 80 cents. The next morning, it's positive again. It feels important because it's your money. But those tiny movements aren't the lesson. The lesson is learning that the market can move every day without requiring you to make a decision every day. Your first $100 isn't going to make you wealthy. It's supposed to teach you how to behave before you have enough money for your emotions to become expensive. Then comes stage 2. This is where investing becomes a habit instead of an event. You decide that every payday, a fixed amount goes into your portfolio. Maybe it's $300. Maybe it's $500. Maybe it's $1,000. The exact number depends on your situation. The important part is that the contribution happens whether the market feels comfortable or not. Stocks are up. You contribute. Stocks are down. You contribute. The headlines are optimistic. Same contribution. Everyone suddenly thinks a recession is coming. Same contribution. You've stopped asking the market for permission. And that's a bigger advantage than it sounds. Because you don't need to predict the perfect day to invest if your system keeps buying over time. At first, the progress is almost invisible. You reach $2,000. Then $4,000. Then $7,000. Nobody calls you wealthy. You probably don't feel wealthy either. But you're building the habit that matters. And eventually, you cross $10,000. That's when something unexpected happens. The number gets bigger. But the excitement gets smaller. And that is where the real psychological test begins. Stage 3, $10,000. This is where investing starts messing with your expectations. You finally reach a number that once sounded meaningful, and somehow it doesn't feel meaningful anymore. You look at the balance and think about the time it took to get there. 2 years of contributions. 2 years of waiting. 2 years of watching other people spend money while you kept putting yours into an account you barely touched. And then you compare it to real life. A friend buys a new SUV. Someone at work talks about the house they're closing on. You see people your age taking expensive vacations and posting every picture online. Meanwhile, you're staring at $10,247 and wondering whether you've actually gotten anywhere. That's when the questions start. Maybe your fund is too slow. Maybe you should pick individual stocks. Maybe you should trade options. Maybe everyone talking about crypto was right. Maybe you should stop investing for a while and actually enjoy the money you've worked for. The dangerous thing is that none of these thoughts sound completely irrational. They sound like you're trying to make a smarter decision. But sometimes you're not looking for a better strategy. You're looking for something more exciting because patience has stopped feeling productive. That's the trap of the middle. Nothing dramatic is happening. Your account is growing, but not fast enough to impress you. Your contributions are working, but you can't see the future they're building. And because the results aren't obvious yet, quitting can feel harmless. You tell yourself you'll start again later. Then later becomes next month. Next month becomes next year. And eventually, the system you built disappears. The people who make it through this stage learn something uncomfortable. Wealth usually gets built during periods when nothing interesting is happening. You keep contributing. You keep living your life. You stop needing every month to prove that you're getting richer. Then the market gives you a test that is impossible to ignore. Stage 4, the crash. Imagine your portfolio is worth $80,000. Monday morning, you're down 6%. That's uncomfortable, but manageable. Then another bad week hits. Now you're down 15%. You start checking the market during lunch. You check it before bed. You tell yourself you're only looking because you want to understand what's happening. But you already know what's happening. Your money is disappearing. Then the decline reaches 25%. Now the percentage doesn't matter as much as the dollar amount. That's money you recognize. A few years of contributions. A future down payment. A serious chunk of your retirement. Your phone is full of alerts. The news is showing red numbers all day. Someone you know says they've moved everything into cash. And suddenly, selling doesn't feel like giving up. It feels like protecting yourself. That's what makes a crash so dangerous. Your brain doesn't tell you, do something stupid. It tells you, save what you've built. It tells you, you can buy back in after things calm down. But there's a problem. Nobody rings a bell when the bottom arrives. By the time the situation feels safe again, prices may already have recovered. This doesn't mean you should blindly hold every investment forever. Sometimes the investment really has changed. Your financial goals can change. Your risk tolerance can change. A company can deteriorate. Those are legitimate reasons to reconsider a position. Fear by itself is different. If the only thing that changed is the market price, you have to be careful about turning temporary pain into a permanent decision. Because a market decline on your screen is not automatically the same thing as a permanent loss in your life. The investors who survive this stage aren't necessarily the people who feel nothing. They're the people who made their important decisions before they were scared. They already knew how much risk they could handle. They already had a plan for bad markets. So when the headlines became unbearable, they didn't have to invent a strategy while panicking. They simply followed the one they had already chosen. And if you make it through that stage, the relationship between you and your portfolio starts changing. You stop expecting the market to make you feel comfortable. You learn that discomfort is sometimes part of the process. Then, eventually, the account reaches another number. $100,000. Stage 5, $100,000. The first time you see 6 figures in your portfolio, you might just stare at it. Because this is where the math starts feeling different. At $10,000, your contributions are doing most of the work. At $100,000, the portfolio itself can suddenly move by thousands of dollars. A strong month can add more than you used to invest in several months. A bad month can take it away just as quickly. For the first time, compounding stops sounding like something from a finance textbook. You can actually watch it happening. And that creates a new temptation. You start thinking about what you can afford now. A nicer car doesn't seem completely unreasonable. A bigger apartment feels possible. You start upgrading small things because the account looks healthy. That's how lifestyle inflation usually begins. Not with one outrageous purchase. With a dozen purchases that each feel perfectly reasonable. And if your expenses rise as quickly as your investments, the bigger portfolio doesn't necessarily make you freer. It just gives you a more expensive life to maintain. That's why $100,000 isn't the finish line. It's proof that the system is finally becoming powerful. And once the system becomes powerful enough, the mistakes become more expensive too. That's where the next stage begins. Stage 6, $250,000. At this level, investing stops being mostly about accumulation. Now you're managing something that can meaningfully affect your future. A mistake that cost a few $100s early on can now cost thousands. Taxes matter more. Diversification matters more. Risk matters more. You stop asking only, how much can this make? You start asking, what could go wrong, and what would that cost me? Maybe one sector has become too large. Maybe your portfolio is more aggressive than you realized. Maybe you're paying fees you never noticed when the account was smaller. This is also where professional advice can become worthwhile. A good CPA might uncover tax savings that more than cover the fee. A good financial planner might spot a risk you couldn't see because you were focused on returns. The point isn't that someone else should control your money. It's that the cost of mistakes has changed. At $10,000, some lessons are cheap. At $250,000, some lessons are not. Your job has changed too. Early on, you needed to invest consistently. Now you need to protect what you've built while continuing to grow it. Then something even more important can happen. Your portfolio starts paying for part of your life. Stage 7, your money starts paying you. Imagine the first month your investments cover a real bill. Not money on a spreadsheet. An actual expense. Maybe your rent. Maybe your mortgage. Maybe your groceries. At first, it might cover only one piece. Eventually, more of your monthly life can be supported by assets instead of your paycheck. And that's when work starts feeling different. You still go to work. You still earn your salary. But imagine your boss tells you tomorrow that your job is gone. You'd be stressed. But you wouldn't be trapped in the same way. You could take your time finding another job. You could negotiate instead of immediately saying yes. You could take a few months to build a business. You could leave a situation that was making you miserable. That's what financial independence actually buys. Not a flashy lifestyle. Options. The ability to make decisions without every decision starting with, can I afford to lose this paycheck? And then you reach the final stage. Stage 8, $1 million. $1 million doesn't make every problem disappear. It doesn't guarantee a perfect retirement. But it changes what your money can do. At $1,000, you searched for opportunities. At $100,000, you started seeing compounding. At $1 million, your capital itself becomes a serious financial resource. More opportunities may become available. But the biggest change isn't how other people treat you. It's how much control you have over your time. And that's why we have to return to the opening scene. The market crashes again. Your portfolio falls 20%. Then 30%. Your phone fills with warnings. Your finger moves toward the sell button. You feel the same fear you felt years ago. But now you know something different. The goal was never to avoid every market decline. The goal was to build a financial life strong enough that one decline doesn't control your future. You know your plan. You know why you own what you own. And you know the difference between a genuine change in your situation and a temporary wave of fear. That's the real progression. The first $100 teaches you to become an investor. $10,000 teaches you patience. A crash teaches you discipline. $100,000 shows you what compounding can become. $250,000 teaches you to manage wealth, not just accumulate it. Financial independence gives you choices. And $1 million isn't the end. It's evidence of what thousands of ordinary decisions can become when you give them enough time. So wherever you are, don't underestimate your stage. If you're still building your first $10,000, keep going. If you're watching a market fall, don't let one frightening week make a decision your future self has to live with for years. Because wealth isn't just the number in your account. It's the amount of control that number gives you over your life. And someday, when that red screen appears again, you'll face the same question. Are you going to react to the moment? Or follow the person you decided to become before it arrived? That decision may be worth more than the next stock you buy. If you're somewhere in these 8 stages, tell me your stage in the comments. And if you want to keep building from here, subscribe.